Listen carefully, because if you are holding something like 500 ounces of silver right now, you are no longer in a passive position. You are standing inside a shift that is already forming beneath the surface of the financial system, and most people have not recognized it yet. I am not talking about a short-term move, and I am not talking about a simple price increase that fades with the next cycle. I am talking about a deeper transition in how value is perceived, how wealth is protected, and how assets are repriced when pressure inside the system reaches a breaking point. You need to understand this clearly. The majority of investors still believe they know why they own silver. They think of it as a backup plan, a hedge, something quiet that sits in the background while stocks, bonds, and currencies do the real work. But that belief only holds if the system itself remains stable enough to support that structure. And that stability is no longer guaranteed. That is the part most people are missing. The real issue is not whether silver goes up next week or next month. The real issue is what silver represents when the foundation of the system begins to weaken. Because history has shown repeatedly that major financial transitions do not arrive with clear signals. They begin subtly, quietly, almost invisibly. While the majority continues operating under assumptions that worked in the past, and then something shifts, and by the time it becomes obvious, positioning is no longer easy, it is no longer comfortable, it is reactive instead of strategic. Right now, silver is sitting in that exact position. For years, it was overlooked. It moved sideways. It tested patience. Capital moved into other areas. Growth assets, speculative markets, easy liquidity trades. That environment conditioned investors to ignore silver as a serious strategic asset. But markets do not reward comfort. They respond to pressure. And pressure, once it builds long enough, forces change whether participants are prepared or not. This is not speculation. This is structural. For a long time, silver pricing was dominated by financial mechanisms, futures markets, derivative structures, algorithmic flows. On the surface, everything appeared stable. Supply looked accessible. Pricing looked controlled. But beneath that surface layer, a very different reality has been forming. Demand has been increasing steadily, not because of hype, but because of necessity. Modern systems require silver in ways that are not easily replaced. Your energy infrastructure depends on it. Advanced technologies depend on it. Data systems, communications networks, medical applications. As the global economy becomes more technologically dependent, silver's role expands quietly without attracting attention. At the same time, supply has not kept pace. Mining output has struggled to expand, new discoveries remain limited, costs continue rising, political constraints, environmental regulations, and operational challenges slow development. This creates an imbalance that markets can ignore temporarily, but never permanently. Because when demand continues rising and supply cannot respond, pressure builds, and pressure does not disappear, it accumulates. Now understand this, because this is where most investors make a critical mistake. They expect major moves to be clean, predictable, easy to follow. But real transitions do not behave that way. They are volatile. They are uncertain. They create doubt. Silver does not begin moving in a way that reassures you. It begins moving in a way that challenges you. Sharp rallies followed by sudden pullbacks, conflicting narratives. Analysts debating whether the move is real or artificial. That noise is not the signal. The signal is the change in behavior, and that behavior is already starting to shift. Silver is no longer acting purely as an industrial commodity. It is beginning to show characteristics of a monetary asset again, and that distinction is critical. Industrial assets respond to growth. Monetary assets respond to declining confidence. And confidence, whether people admit it or not, is starting to weaken in parts of the system. Most investors are looking in the wrong direction. They are watching equity markets. They are watching central bank announcements. They are watching short-term economic data. But beneath all of that, something far more important is happening. The foundation of the system is being tested. For decades, financial stability was anchored by one core assumption: that central banks could manage the system, that they could control volatility, that they could provide liquidity whenever necessary. That belief allowed debt to expand at an unprecedented scale. Governments borrowed more. Corporations refinanced continuously. Consumers relied on credit to sustain spending. And it worked because borrowing costs remained low and liquidity remained abundant. But debt behaves differently when conditions change. And conditions are changing. As interest rates rise, the cost of maintaining that debt increases. What once appeared stable begins to show signs of strain. What once felt manageable begins to look fragile. This is not a theoretical risk. This is the natural behavior of leveraged systems. And once stress begins to appear at the foundation, capital starts searching for alternatives. That process does not begin with headlines. It begins quietly. Small reallocations, subtle hedging, institutional adjustments that do not attract attention. But over time, those small movements begin to align. And when they align, they create direction. Silver sits directly in the path of that shift because it exists in two worlds at the same time. It is both a monetary asset and an industrial necessity. When financial confidence weakens, monetary demand increases. When technological expansion continues, industrial demand remains strong. Very few assets operate within both of those forces simultaneously. Silver does, and because the market itself is relatively small, it does not take a massive wave of capital to create impact. Even modest inflows can move price in ways that surprise unprepared investors. This is why silver does not move slowly when conditions change. It reprices, not gradually, not comfortably, decisively. Now, if you are holding 500 ounces of silver, you need to understand what that means today, because your position is no longer passive. It is becoming strategic. And once that transition happens, the way you think about your position must change as well. This is not about predicting a number. It is about recognizing a shift, and the shift is already underway. You need to pay attention to what is happening beneath the surface, because what we are witnessing is not just about silver. It is about the structure of the system that determines the value of everything you own. And that structure is beginning to feel pressure. You need to take this one step further, because understanding the pressure is not enough. You must understand where that pressure leads. Modern financial systems are built on credit expansion. Governments issue debt to sustain spending. Corporations rely on borrowing to grow and refinance. Consumers depend on credit to maintain their standard of living. This structure has been reinforced for decades because it worked under one critical condition. Borrowing remained affordable and liquidity remained accessible. But no credit system expands indefinitely without consequence. At a certain point, the total scale of debt becomes so large that the system requires constant support just to maintain stability. It stops growing naturally and begins depending on intervention. And when interest rates begin rising inside that environment, stress does not remain isolated. It spreads. Governments face increasing interest obligations. Corporations confront tighter financing conditions. Consumers feel pressure through higher costs and reduced access to credit. This is not a theoretical model. This is the natural behavior of leveraged systems under tightening conditions, and that is exactly where we are now. Global debt levels have reached extremes that would have been considered unsustainable in previous decades. Deficits continue even in periods where growth should be reducing them. Central banks are trapped between two conflicting objectives. They must control inflation, but they must also maintain stability in a system that depends on low borrowing costs. Those two goals do not align. If they tighten policy aggressively, they reduce inflation but increase stress across debt markets. If they loosen policy to stabilize the system, they risk weakening currencies and fueling further inflation. This creates a structural tension that cannot be resolved cleanly. And when that tension builds, confidence begins to erode. Not suddenly, not dramatically at first, but gradually. This is where most investors fail to recognize what is happening. They are conditioned to look for clear signals, decisive events, obvious turning points. But structural transitions do not announce themselves that way. They develop through small changes in behavior that accumulate over time. Institutional capital begins adjusting quietly. Allocations shift. Exposure to real assets increases. Central banks themselves begin accumulating precious metals. These actions do not dominate headlines immediately, but they alter the direction of capital, and capital movement is what drives markets. Silver sits directly in that path. Unlike financial assets, silver does not depend on policy credibility. It does not require trust in central banks. It does not rely on balance sheet expansion to maintain its existence. Its value is anchored in physical scarcity and real-world utility. That independence becomes increasingly important as confidence in the system weakens. But there is another layer you must understand. Silver is not only a monetary hedge, it is deeply embedded in the modern industrial economy. This dual role creates a unique dynamic. As the global economy transitions toward electrification and advanced technologies, the demand for efficient conductive materials continues to rise. Silver is one of the most effective conductors available. Solar infrastructure depends on it. Electric vehicles require it. Data centers, communication networks, medical technologies, and advanced electronics all rely on it in ways that are not easily substituted. This is not a temporary trend. It is a structural transformation of how the global economy operates. Industrial demand for silver is driven by necessity, not speculation. At the same time, supply remains constrained. Mining is a slow and complex process. New discoveries take years to develop. Projects face regulatory challenges, environmental restrictions, and financial risks, and a significant portion of silver production is tied to the extraction of other metals, meaning supply cannot respond quickly even when prices rise. This creates a persistent imbalance. Demand can increase rapidly, supply cannot, and when that imbalance remains in place long enough, markets are forced to adjust. Not gradually, but decisively. Now consider the scale difference between silver and the broader financial system. Global equity markets represent tens of trillions of dollars. Bond markets are even larger. Institutional investors control enormous pools of capital that must be allocated somewhere. The silver market, by comparison, is extremely small. This creates a powerful condition. It does not require a massive global shift to move silver significantly. It requires only a change in attention from a relatively small portion of global capital, and that attention is beginning to shift. This is why silver has a history of sudden, aggressive moves. It remains quiet for extended periods while conditions build. Then, when capital begins flowing in, price adjusts rapidly. Investors who wait for confirmation often find themselves reacting too late. They follow the move instead of anticipating. This is where perspective becomes critical. If you are holding 500 ounces of silver, you are not simply holding a commodity. You are holding exposure to a system that is undergoing transition, and transitions are not smooth. They are volatile. Volatility creates doubt. It creates hesitation. It forces you to question your position. But you must understand something clearly. Volatility is not always a sign of weakness. Often, it is a sign of change. Periods of calm reflect stability or complacency. Periods of turbulence reflect adjustment. Markets shifting from one equilibrium to another do not move in straight lines. They move in waves. During those waves, ownership changes hands. Short-term participants exit positions. Long-term holders accumulate. Institutions build exposure gradually. The character of the market shifts from speculation to conviction. Silver has followed this pattern repeatedly throughout history. Long periods of neglect, followed by sudden attention, followed by rapid repricing. Each time, the explanation seems obvious after the fact, but the conditions that created those moves were visible long before. They were simply ignored. And today, many of those same conditions are present again. Debt levels remain elevated. Monetary policy remains constrained. Inflation pressures continue influencing decisions. Governments rely on borrowing to sustain spending. Each of these forces pushes investors to reconsider how they protect wealth. Silver is part of that shift. Not because of hype, not because of temporary narratives, but because of its position within the system. It reflects deeper forces, and when those forces begin to align, the impact is rarely subtle. Now you need to understand the next layer, because recognizing structure is only the beginning. The real transformation occurs when perception changes. Markets are not driven by data alone, they are driven by belief. And belief, once it begins to shift, can redefine the entire financial landscape faster than most people expect. For years, investors operated inside a framework that felt reliable. Governments issued debt and markets absorbed it. Central banks intervened when instability appeared. Bonds provided safety. Equities provided growth. Precious metals existed on the sidelines, rarely necessary except during moments of extreme stress. That system worked because confidence held everything together. But confidence is not permanent, it is conditional, and when the conditions supporting that confidence begin to weaken, behavior begins to change. Not all at once. Not in a way that is obvious in the early stages. But gradually, investors begin to question assumptions that once felt unquestionable. They start asking whether the system can continue functioning the way it has. They begin exploring alternatives, not out of fear, but out of necessity. And once that process begins, it rarely reverses quickly. Look at what is happening globally. Debt continues expanding across developed economies. Fiscal deficits remain persistent even during periods where growth should be stabilizing them. Central banks are navigating an increasingly difficult balance between controlling inflation and maintaining financial stability. There is no simple resolution to this. Tightening policy introduces stress. Loosening policy introduces inflation risk. Every path carries consequences, and investors are beginning to recognize that reality. That recognition changes behavior. Institutional capital does not wait for public confirmation. It moves early. It reallocates gradually. It positions before the broader market fully understands what is happening. And when enough capital begins moving in the same direction, the effect becomes visible. Silver is positioned directly inside that transition. It is not just an industrial input. It is not just a hedge. It is not just a commodity. It is a signal about the health of the monetary system, a signal about confidence in currencies, a signal about how capital is responding to structural pressure. Signals like that do not appear randomly. They emerge when underlying conditions begin to shift. Now consider the psychology of markets during these periods. Most participants do not act early. They wait. They look for confirmation. They rely on consensus. But by the time consensus forms, the opportunity has already changed. Early stages are always uncertain. They feel uncomfortable. They lack clear validation. That is why most people hesitate. But hesitation has a cost, because once attention returns to a neglected asset, capital follows. And when capital flows into a market with constrained supply, price does not respond gradually. It accelerates. This is why silver does not move in a predictable linear pattern. It moves in phases. Long periods of quiet accumulation, followed by sudden bursts of activity, followed by volatility that tests conviction, followed by continuation that surprises those who waited. This cycle has repeated throughout history. Neglect, accumulation, recognition, repricing. The pattern remains consistent. The only variable is scale. And the scale today is influenced by a financial system that is larger, more interconnected, and more dependent on continuous expansion than at any time in the past. That matters, because when imbalances form inside large systems, the adjustments required to correct them are rarely small. They tend to be significant. Now, if you are holding 500 ounces of silver, you need to understand the implication clearly. You are not holding something insignificant. You are holding an asset that exists outside the promises of the financial system. An asset that does not rely on policy decisions to maintain its existence. An asset that participates in both monetary protection and industrial demand. That combination is rare, and rarity matters when conditions begin to change. But you must also understand this. Ownership alone is not enough. Understanding determines how you respond when volatility increases, and volatility will increase. This is not a possibility. It is a probability that continues to rise as pressure builds within the system. The real question is how you interpret that volatility. Do you see it as instability, or do you recognize it as transition? Do you react emotionally, or do you remain grounded in the structure you now understand? Because this is where most investors fail. They understand the thesis during calm periods. But when markets become unpredictable, when narratives conflict, when uncertainty rises, they abandon their positions at the exact moment the cycle begins accelerating. And that is how wealth transfers occur. Not because people lack information, but because they lack conviction. Those who understand the cycle early position themselves before the shift becomes obvious. Those who wait for confirmation arrive after momentum has already begun. And once momentum builds, it does not slow down to accommodate late participants. This is why you need to pay attention now, not because of headlines, not because of short-term predictions, but because the structure is changing. The environment surrounding your assets is evolving, and when silver transitions from a passive holding to a strategic position, everything changes. This is no longer about simple diversification. It is about positioning inside a system that is under pressure. It is about recognizing that cycles do not last forever. It is about understanding that when trust begins to weaken, capital begins to move. And when capital moves into assets like silver, the response is not gradual. It is decisive. The real question is not whether that shift will happen. The real question is whether you will recognize it early enough to understand what it means for your wealth. Because by the time it becomes obvious, the repricing is already underway